Hello and welcome to today's CMS Forex Daily Market Recap. My name is Nick Nassad. Today is Thursday, October 29th, 2009. We'll start today's recap with a little rundown of important fundamental releases. The big news for the day was US GDP for the third quarter. This was the first release or the advanced release, and came in at a 3.5% annualized pace, which was better than expected and shows that the US economy has pulled out of recession in the third quarter. A good thing to note is that personal consumption rose 3.4% on the back of government stimulus for consumer spending in the form of cash for clunkers, and also in the housing market where an $8,000 tax credit for first-time homebuyers helped to increase demand and helped to increase residential construction. The question now is, as that government stimulus is removed, while unemployment remains high, what will be the strength of the recovery and the rate of growth in the fourth quarter? The GDP data comes juxtaposed against jobless claims that showed 530,000 Americans filing first-time claims for unemployment benefits, a level that was very close to the previous week. It was also above expectations, so it was a disappointing release. On the other hand, continuing claims, or the total number of people continuing to receive benefits, did drop from 5.92 in the week ending October 10th to 5.79 million in the week ending October 17th. Now, the weak U.S. labor market is still a major sore spot for the economy, and it'll have an impact on consumer confidence and spending, and that's going to be very important for the holiday shopping season. Overall, though, the better-than-expected GDP release outweighed today's jobless claims report and helped to increase risk aversion in New York trading. To a release from the Eurozone, the German unemployment rate fell in October to 8.1% in seasonally adjusted terms, while the number of people out of work declined by 26,000, a figure that surprised forecasts that had called for an increase in unemployed. The German government has been taking steps to keep companies from firing their workers by giving incentives for firms to cut work hours as opposed to laying off workers, and that has helped to keep the unemployment rate from rising dramatically during this recession. For instance, the unemployment rate 1 year ago was around 7.5%. The data is going to be a positive sign for the German economy, and hopefully translates to higher consumer spending as the economy comes out of its recession. With that fundamental data out of the way, let's take a look at the euro-dollar pair, where we see a strong rally in favor of the euro in today's trading, with a big jump coming following the US GDP report between 8:30 and 9. That helped the pair to sustain a rally that started after it bounced up off support around 1.4680. We came to a high around 1.4860, and that amounts to about 160 pip change from today's low to today's high. If we take a look at the past 3 sessions, we see that today's trading broke our downward sloping resistance line. First it bounced down off of it, but then it was able to break through around 330 in European trading. If we look at the pair from a 4-hour perspective, we see that today's support goes back to area around October 11th. And that support area held in today's trading. Today's support also coincided with a Fibonacci retracement of our rally from October 2nd to earlier this week, around the 61.8 area. Now, that's a pretty healthy retraction from a strong rally. And since we didn't penetrate the 61.8% area and we had a pretty strong bounce up off of it, it could imply that the uptrend we saw earlier may continue. If we plot another horizontal trend line, we see, however, that the area where we found resistance today also matches up fairly well with where we were to begin last week and to end 2 weeks ago, around 1.4850, and so we have to penetrate that important level of resistance in order to see a further move up in this pair. We now move to the Euro-Yen pair, which for the past 3 sessions this week has been falling, and yesterday fell rather dramatically on the back of increased risk aversion and falling stocks. Today we saw the opposite, where stocks rallied around the world, and with the US GDP coming in better than expected, this pair, the euro, was able to claw back its losses from yesterday's session. From its low around 132.80, we moved all the way up to near the 136 level, a change of about 300 pips. Today's rally stalled right at the same level where we opened yesterday's session, and if we plot some FIBO levels, we see that it was about a 50% retracement, though we moved a little bit above 50 of our swing from the start from this week's high to this week's low. If we switch over to the US dollar Japanese yen pair, we see similar price action, though the fall here in this pair wasn't as sharp as it was against the euro. The dollar managed to reclaim about 61.8% of its fall from the last 2 sessions and the overnight Asian session in today's trading. Our level of resistance now comes from a horizontal line from earlier this week around 91.60 here. In the UK, a fundamental release showed that mortgage approvals, as measured by the Bank of England, rose to 56,000 for the month of September, a figure that was above expectations and could add evidence that the housing sector continues to recover from its deep downturn during the recession. There have been other good points of data in the UK housing sector, like rising housing prices and what seemed to be some easing in lending conditions. If we take a look at the pound dollar, we see that the pound also rallied against the Greenback, moving out of its sort of upward sloping little consolidation zone here. Depending on how you draw these levels. We had a little breakout and we found resistance at 1.66. The reversal of fortune for the greenback strength was evident in our commodity currency pairs like the US dollar, Canadian dollar. After reaching a high to begin today's trading session, the Canadian dollar was able to bounce down off this resistance level and reclaim most of its losses from yesterday. It found support here around 1.650, which was the level of consolidation earlier this week. So this will be an important level to monitor, whether we have another move up in terms of greenback strength, or if risk appetite remains strong to end the week, if we can break below this 1.0650 level on the downside. If we turn to the Australian dollar US dollar pair, again we see a lot of the Aussies losses from yesterday paired, and we found support near resistance near 0.9180. Today's resistance came as a 61.8% retracement of our fall from our high near 93.25 we saw in the middle of last week. So you see how that bounced very neatly off the 61.8% retracement level. So overall, today's session has seen a very dramatic reversal of fortunes that we saw just yesterday, though maybe perhaps traders believed that the falls recently may have been overdone, and we did see a nice correction. So how investor sentiment fares on tomorrow's trading will have a lot to do with whether we extend these gains from today's trading, or if this was just a correction to greenback strength, which was evident earlier in the week. So with that out of the way, let's take a look at some upcoming releases and from around the world. Tonight we're going to have a lot of data come out from Japan. It's the end of the month, so they release a lot of their reports around this time. Included in those reports would be measures on manufacturing, on household spending, consumer prices, both in the Tokyo region and in the entire country, the unemployment rate, And the Bank of Japan will meet about interest rates, and so it'll be interesting to get their update on the economy. Also, some other reports will be UK consumer confidence, Australian private sector credit, and overnight we're going to get flash consumer prices from the Eurozone as well as the Eurozone unemployment rate. Tomorrow in the US, we're going to get some data about consumers, including personal income and spending, and the employment cost index, and the final version of the UMich consumer sentiment. We also are going to get the Chicago PMI, which measures business conditions around the country, and a very important measure of inflation that is watched by the Fed, the core PCE price index. So tune in tomorrow and we'll tell you how those releases went and if they were able to affect the markets. And that'll wrap it up for me and today's daily market recap. Thank you for joining us and happy trading.